Hi. Well, good afternoon, everyone. I'm Iriarte. I'm head of PR and communications at 0100 Conferences. I'm also host of the Impact Talks, a space where LPs and GPs from private equity and venture capital have the opportunity to talk about ESG and impact from their own perspectives and needs and definitions. I'm very happy to be here and very thankful to Impact Days for inviting me to moderate this very interesting panel about embedding ESG and impact into financial instruments, progress, gaps, and what is next. I'm very happy also to be joined in this panel with Cyril Gouiffès. Did I pronounce it correctly or not? Exactly. Gouiffès. Yeah. Well, he's the. Okay, there it is. Okay, we were just like practicing, no? But we can still. This is just the introductions part, so it's okay, right? So Cyril is the head of social impact investing at the EIF. Also, we have Alina Klarner. She is the founding and partner and GP at Impact Shakers, right? Josefine Schulze, she is the managing director of WOMENTOR, right? And Nisha, Kohli, CEO and founder of CorpStage. Well, we have a very diverse panel here, and I would like, before we start jumping into the questions, please, Cyril, grab a microphone and give us like short introduction about yourself, your role at the EIF.
Thank you, Laura. Hi, everyone. So a short introduction on myself. So working for the European Investment Fund. The European Investment Fund is part of the European Investment Bank group. So the reason, the overriding mandate of the European Investment Fund is to increase or favor access to finance for European SMEs. We do that as a wholesaler, meaning on the debt side, we issue guarantees to banks so that they can lend a portfolio of loans on certain thematics and regions. On the equity side is as simple as a fund of funds. So we look at fund proposals, make investment decisions on these fund proposals, and ultimately invest in those to expand and make sure that there is appropriate funding for impact SMEs at large in Europe.
Wonderful. Thank you very much. What about you, Alina? Tell us a bit more about Impact Shakers, the ecosystem and the fund, please.
Yes. So Impact Shakers is both an ecosystem builder and an impact investor. We started with the ecosystem building in 2018, and it's really about bringing together the European ecosystem of impact actors, from investors over academics, accelerators, other ecosystem builders, anyone really working on building the impact economy. So we do programs, we do knowledge sharing, best practice tools, etc. And then since 2022, we've added capital as well, because we were sort of seeing that with all of the programs and the advice and the support, still nothing much was changing in terms of how much capital went specifically to diverse founders. And so we first set up a micro fund, which is our friends and family vehicle that really invests at the very early stages. And then in April last year, we launched an impact venture fund that invests at the pre-seed and seed stage, thank you, in diverse teams, building scalable businesses in climate tech, inclusion tech, and impact infrastructure.
Wonderful, thank you. What about you, Josephine?
Hi, so nice to see you all. Thank you so much for having me on the panel. So I'm a managing partner of WOMENTOR. This is a social business based in Austria. We're doing also a lot around consulting for larger companies when it comes to diversity, equity, and inclusion. And I also own a company, and it focuses around impact analysis and impact measurement. And I'm really looking forward to this panel today.
Wonderful, thank you very much. What about you, Nisha? What is a CorpStage?
Hi everyone, I'm CEO and founder of CorpStage, a company based out of Singapore. As the name suggests, CorpStage is the stage where corporates perform, and these corporates range from small scale to medium scale to large enterprises. You can imagine this platform as very similar to EcoVadis, where corporates in a public profile can be shared with their investors as well as their buyers, because supply chain is a big challenge. How do we do that? We are actually on a very ambitious plan, the CorpStage platform, to eliminate the need for secondary rating and ranking agencies. And how do we do that? By bringing primary organic information directly from the companies to the stakeholders publicly. Yeah, thank you.
Great. Please don't leave the microphone, because I want to ask you the first question. The panel is about embedding ESG and impact into financial instruments, right? And here we have different actors from the industry, but I think the most important part is to set the stage with CorpStage and tell us a little bit what is going on in terms of embedding financial instruments, ESG and impact into financial instruments here in Europe compared to Singapore, and what's the status today?
Yeah, that's a great question actually to start with also. As we all know that Europe has been the leader in terms of regulations and in terms of particularly regulating the financial markets, and we started with SFDR, EU taxonomy, Green Deal, etc. And it was going great until 2023, up to 14% of the assets were under management considered ESG. However, there were challenges related to greenwashing, and we've also seen that. That's a different thing, but overall, with the implementation or introduction of other regulations such as CBAM and EUDDD, CSRD and others, caused a rippling effects on Asian countries such as Singapore, Thailand, Malaysia, India, and many others, because they are exporting countries to the western part of the world. Following that, Singapore launched ASEAN taxonomy, and then even with that ASEAN taxonomy, countries like Thailand, Malaysia, India, Philippines, they all came up with their own taxonomies for the financial instruments. So I would say, you being the leader, they actually led the path and caused the growth or emphasis of this ESG and sustainability in the other parts of the world. However, the stakeholder part, which is the ask from the stakeholders here in EU, is much more impactful than in Asian countries, because that's the awareness and the infrastructure, knowledge, etc. still lacking. But having said that, it's still going very well. A lot of capacity development programs, a lot of government subsidies, regulations, etc. are evolving and growing day by day. So that's going great. Now, coming to the current situation, and I've been visiting EU for the last 1.5 years very frequently, and other than that also I was here from 2022 onwards very frequently. I've noticed in the recent couple of months, from January this year, 2025, that with the pushback on the regulations such as Omnibus Directive, we have seen the when the Trump took office, then tariff wars between US and China, and of course Russia and Ukraine war. So these kind of situations have led the inflation and the dedicated funds which were going to clean tech, about 750 billion to 800 billion per annum. Now that's going to reduce with the allocation to the defense budgets, and the energy inflation will cause more diversion from the renewable energy to the fossil fuels, which are, of course, cheaper. So, those are negative influences. And then the third one is Omnibus Directive, which is pushed back by corporates for ESG information. And, there's too much of data requirement. 1,100 data points are there on CSRD, and companies were not ready. And that's a different story, because they were not prepared, their approach was not right, and things like that. However, now, the thing is that when it comes to financial institutions, this lack of direction or regulation, or the pushback of the regulation or delay of the regulation, will cause transparency issues and will have an impact on the ESG integration into financial investments. Yeah, thank you.
Wow, that's very interesting, and it's what's been going on in the last 3-4 months, right? I mean, there's no longer the ESG and impact used to be a buzzword, now it's not anymore. We were talking about this before, now it's dual-use technologies, defense, and all these other topics, the ones that are taking the stage, basically, right? And then we will get to ask Cyril a bit more about maybe we can let's just jump to you, Cyril. I'm not gonna follow the order here. No, but I mean, the EIF is the main venture capital investor in Europe, you know? What is your, first two things, maybe you can follow a little bit with what Nisha was saying, no? What's the status right now in terms of the relevance of impact and ESG data reportability since everything changed these last 3 months, no? And the other question is about what is it that you are looking for as the EIF when you are screening for funds?
So on your first question, Laura, I think we do not see. I mean, we have a stable source of funding for impact investment strategies across Europe. So obviously today, May 2025, we do not see a drastic change compared to what it was in December 24 or January 25. That's, I think, a very important element because we see ourselves as, again, a stable, steady source of funding and reliable partners for the funds we were invested in or that we are looking at the moment. We receive a lot of interest. We do screen on a regular basis, and as we've done in the past 10 to 12 years, specifically on impact. What we do see, though, to answer your first part of the question, is that, and that's perhaps the more concerning bit, is that we see evolution of the interest of LPs in general for impact, and even some funds where perhaps we've committed in Q4 2024, having the understanding of a target size of X, a minimum fund size of Y, are now picking up the fund and telling us, okay, is there something you can do around your commitment, or perhaps on going beyond the initially intended ratio in the fund, because we do see a number of LPs for different reasons withdrawing. So I'm not, I think this is also a consequence of just very short-term context we live in. So that does require some adaptation. However, we do see our role as being more important than ever in the context, because you were referring to buzzwords. Indeed, it's fair to say that impact investing has been very much in the hype, and so this is positive, I must say, because we've been struggling for long, and perhaps 10 years ago when I was sitting on a panel here in the Impact Days conference, the big question was around what can we do to have more funds looking at impact? I think we're there. Now we have to make sure that there is also a constant support and a constant demonstration that it is actually possible to build this positive correlation between financial performance on the one hand and impact performance on the other. But our role as a public investor in these strategies, I think, remains very important, and we're committed to continue, keep a steady pace of investment and volumes of volumes. We invest roughly around 200 million exclusively on social impact strategies every year. That's our cruising speed, so that and across perhaps 10 fund investments. So what we are careful is around making sure that the funds as a whole are optimally capitalized to deploy their strategy in the best condition possible, because you do not want to have another layer of risk, like operating a suboptimal fund size, hitting your diversification in the portfolio. So that's what we are coping with at the moment. So
Yeah, and maybe we can go to Alina, because as Cyril was saying, have you seen this LP appetite? And I know I'm going out of script here, but have you seen the LP appetite? Because you have an impact fund, right? Is it different now compared to what it was a few months ago when you're in the process of fundraising this first fund? And do you see there's something different in the environment?
Do I see it in the market? Yes. Do I see it for us? Not necessarily, because the niche group of people that are willing to back a first-time fund with 2 female fund managers, investing in diverse teams, in climate tech and inclusion tech, is as committed as they've ever been to making this happen. They still believe that we would all like to breathe clean air. We would all like to live in houses that don't burn down once a year. We would all like access to good education, good health, good financial services. So for us specifically, I would say less so. But I think it's also an opportunity, right? As all of this, our sustainability is dead. I think it's an opportunity to look at what we need to do to drive valid business models that go beyond the regulations, right? And what do we need to do with funds that invest beyond Article 8.9? What do we do with startups that are in this space, that are building? So I think we're seeing a bit of let's say, a growing up of the industry, maybe.
And what do you think, because we have around 2,400 active venture capital funds in Europe, what's the level of maturity that you see, especially from your approach, with this, which is the most like social approach, right? Impact Shakers has this, and then we can also talk about this with Josefine, right? I mean, how do you see the embedding of social aspects of ESG and impact into the industry, no, into your peers? Right, and also in your case, Josefine, in terms of in the companies. Maybe you can start.
I'll start. Okay. So I think at the dinner yesterday we heard Uli's summary that we've been through a phase of focusing very much on impact measurement and management. I think in a way, maybe we've been a little bit too comfortable in sort of relying on the existing model, where we say, okay, for each company we pick 1 or 2 metrics. This is our North Star, and this is how we measure impact. What we have seen also with our fund is that if you invest at the very early stages, the businesses often don't have their final product yet. They don't know who their ideal customer is. So to then say, okay, this is the one metric that is going to tell us if we're having impact or not, is, I'm going to say, almost impossible. So what we've actually done is we have developed, in line with the commercial readiness levels and the technology readiness levels, an approach that has impact readiness levels, where we say, okay, we start with level 1, an impact intention, a mission, everyone is aligned. Level 4, 5, we get to a point where maybe the impact is validated, you can repeat it in a second segment, and then level 8, 9, you get to a point where you have product impact market fit, and you can actually lock in the impact in this lockstep business model for the long term. And so the way we're approaching it is to say, we're not going to just use the one KPI that in the early stages often is also linked to financial scale, right? It's often you don't really have your North Star impact yet, you have a financial scale metric essentially, and we will look at what do we need to integrate into how we build the product, how we do the go-to-market, what needs to go into the legal agreements, what needs to go into how we build the team, and how can we advance this level by level, and then use that to set a target for ourselves to say, okay, we commit to getting the businesses from level 1 to level 5 in the first 4 years of our investment.
We jump to Josefine, because you have the ecosystem as well, right? And maybe what was your role before, until like compared to what you do now? You know, because before you were in the ecosystem, you were very involved, no, with the startups, and so you probably are part of this process of maturing, no? I mean, from what a startup had maybe 5 years ago and what a startup has now in terms of ESG as part of their strategy. What do you think? I mean, how's this process?
Yeah, so the role has always been to help startups succeed and scale. It's just that now we actually have the capital to help them make it happen.
Wonderful. So Josefine, going to the diversity and inclusion part, no? And you're also part, because you have WOMENTOR, you know, where you focus more to diversity and inclusion and equity. And then you have the other part, which is the government agency, consulting role, you know, maybe you can tell us a little bit more about that and how relevant it is to push the social part, because we see a lot of like financial instruments that focus more on the environmental part of ESG, right? Like green bonds, etc. But what about the social part? Have we, how mature are we in terms of embedding social tools into these types of instruments.
So I think when we're looking into the trends at the moment, and we maybe all heard that SAP is one of the first German-speaking companies who is deleting basically the diversity, equity, inclusion efforts. This brings us a little bit to the trends. At the same time, we are also seeing that 90% of the companies staying with their efforts to do diversity, equity, inclusion. But with WOMENTOR, we do a lot of strategies for large corporates. So we support them to really have a good and strong strategy and then trickle it down to whatever they need. But my approach also from the last 10 years of working in this field is that a good strategy should have the E and the S and the G dimension. So it shouldn't only focus, but of course it's sometimes really necessary to start with something, and then go from there to the other levels. But what I always preach is that it is still important to look into the impact analysis and into the impact measurement. Even so we're talking a lot about this, neither for the funding houses, so for public institutions, nor for many of the startups I'm coaching and supporting, nor for the capacity building programs. I see a lot of this really integrated and incorporated. I know it is a little bit different. For instance, with the impact shakers, you have really a strong program when it comes to this. There are many VCs who has a focus there, but when it comes to the public funding, it's still let's say in the Kinderschuss, at least in Austria. But there are things happening, and this is what you also mentioned. I'm also supporting funding houses like Vienna Business Agency, I did for a couple of years, and now the AWS, to find their strategy when it comes to ESG, and then always having the capacity buildings for the teams and the people inside of these organizations, because more than you might think, they have a lot of options and opportunities to also shape the programs and the projects and also the fundings and the funds. We are also seeing right now a trend and trying to support here a lot when it comes to who gets a funding. How can you choose this? What could be a scheme? How can you decide this? Who is the jury? How do they know about sustainability and ESG? I think this is still a really important part, so we're pushing there a lot. And we're really working day by day with the startups and with the founders, teaching them in workshops, in trainings, in coachings. Thanks to the FFG, we also got the funding to work on a tool to help and support startups and SMEs with their VSME, with their voluntary sustainability reportings. And also to the points you said before, I think we have now a standard with the European Social Reporting Standard. This is, was written, or it is written for companies, but we do have a standard who is also putting the social factor and the social indicators into a framework. But still, we need to roll up our sleeves and do a lot of work, because Austria is ranking on place 47 when it comes, for instance, to gender parity. Afghanistan is place 147, Austria is 47. Countries like Germany, I think 5 or 6. So there is still something to do here. And this also means something when we're talking about the financial landscape and who gets the funding, what is funding, how is it seen. I think Alina knows there a lot when it comes to this part. And I'm really grateful that there are funds, for instance, from Female Founders, the Grow F Fund, who has a focus there and is supporting there. But now more than ever, it is a lot of effort needed that we do not lose this focus, that we're not, shifting again, as you were saying, with the focus and the trends. There is a lot of shift, so we need to stay focused on the topics on ESG.
And how? Because Cyril just said it. They can be focused. They are willing to invest and keep paying attention to these specific topics. But then if the rest of the investors are not on the same line, how can we make sure that these trend don't ends up being just a trend, right? And I think one part is the regulation, right? Nisha, maybe you can tell us a little bit more. What do you see is going to happen? No, in the future, I'm not telling you to guess, no, but from what's going on right now, maybe yes, some stuff are no longer that relevant for some companies, but then you were saying you were working a lot with SMEs. What are you seeing there? Because those are the moves, the ones that move the economies, at least, I don't know, I'm based in Spain and 90% of the companies are SMEs, no? So maybe you can tell us a little bit more about that. How are they embedding ESG, and how are maybe the ones that finance these type of companies are embedding ESG?
So to answer this question, I'd like to go back to 2008 or maybe 1999, when Enron thing happened and we got SOX as a regulation, like Sarbanes-Oxley Act for internal controls and audit. And then 2008, we had all the corporate governance codes. Before, we were not talking about ESG, but we were talking about CSR and corporate governance around that time. And even after those regulations, we saw subprime crisis, we saw the banks failing and things like that. And today we have ESG regulations which were like debated a lot around 2019, 2020. And then we still had those like SFDR when it came on 10th of March, I remember. There was so much of UN crime and like a lot of posts were around that how immediately it is being made mandatory, right? So things like that. Regulations do their bit, yes, but they are not 100% effective. So what is effective? Like, how can we bring that focus? Is about, again, as you said, Josefine said, that is about, they're creating a lot of awareness and, knowledge sharing, etc. That's what is important, even at the largest listed company levels. So what I want to say here is that when we are working with our clients, whether it's SMEs or large companies, we first check, like if it is a large company doing ESG for the past 3 to 5 years or 7 years, we still emphasize that we want to look at what is your ESG strategy, what's your roadmap, are you integrating these strategies with your business strategy? Companies have a small team, like I've seen companies with 40,000 employees also having a small team of 3 to 5 people in ESG and sustainability, and then they pay heavy salaries to the chief sustainability officers. Even then, it just revolves around reporting. And then that reporting, unfortunately, it's sad to say I don't want to, not with every company, but it becomes a checklist kind of approach. And that approach really doesn't work. So what's important, even at the largest companies, like we work with, startups or SMEs, impact measurement is the most important thing. And how that impact measurement can happen is by fully integrating sustainability mindset in business strategies. That's what will work in the long run, and we have to forget this term like ESG. Okay, we have it as a buzzword, but let's forget it for a bit and say, let's do the business as usual, but with sustainability mindset and with impact measurement. I think, impact investing has been more than 2 decades or around 2 decades now. It's been working, and it was working fine, it's working. Let's bring that term into ESG space. Let's forget about the regulation. Let's do our bit. Yeah, thank you.
Can I add something on this? Yeah. I think there's also an element of getting out of our bubbles a little bit, right? Because doing ESG for the sake of reporting or for the sake of doing ESG, I think is never going to work. So I'll give an example. One of our portfolio companies works in the space of geo-tracking and digital product passports. Their focus is on the audio industry. To begin with, nice niche, great. Their customers don't want to talk about sustainability. You say sustainability, they run. What they want to talk about is customer loyalty. It's opening up new revenue streams through resale. It's tracking their supply chain and where their products get lost or where they can make things more efficient. So I think there is a bit of mental agility required as well to think about how this creates real business value, which was kind of the intention sort of from the beginning, right?
Yeah, the focus should be on overall stakeholder value creation rather than just the profits or business profits.
But I think, Cyril, you have something to say about this because you do impact invest. I mean, you invest in social impact for the EIF, but you don't care. I mean, about Article 8, 6, or 9, which is the reportability part that we were talking about, not just doing stuff to comply with regulation. And I remember when we were talking last week, you mentioned that, yes, you don't focus on that, but yet you choose the funds that are that have the biggest impact, no? So how do you do that due diligence when you are screening the funds and beyond this Article 8, 6, 9, whatever?
So it's true that it's not a mandatory thing. We do not, when we invest in an impact fund, saying we don't care is perhaps of a far-fetched statement I shared with you over the phone to prepare this panel, but
No, you didn't say you don't care.
No, but I can round angle, but I would definitely assume what I said, and in essence, that's what it means. Because that's where we like to see ourselves as more substance-oriented over form-oriented, because bit of a sanity check here, we have to differentiate very carefully ESG on the one hand and impact on the other. We do have ESG reporting, ESG questionnaires, sometimes fairly heavy ones, ARICON, across each and every investments we close. So infrastructure fund, life science fund, tech fund, they would have to comply with or commit to provide us ESG data. Impact is very different. And for one core reason is because as opposed to impact should never be an externality. Impact is actually what you achieve when you as an entrepreneur, as an investor, actually are driven by the impact you want to achieve, meaning that the impact should always be strongly embedded in the business model of the company. So that's what we're looking for. And because we do, and once this differentiation is clear between ESG on the one end, that is a bit of a must-have, versus impact strategy on the other, that is a strategy, then impact has to, like the whole value chain, from entrepreneurs to investors to LPs in funds, have to be accountable for the impact that is achieved or not achieved. I like to say that it's always easy to use the impact buzzword in your investors deck, more tricky to implement it once the subscription documents are signed. So this is why we do not see impact as being a mere reporting requirement, but rather as an accountability mechanism. When we invest in an impact fund, there will always be at least part, if not all of the carried interest that is subject not exclusively to financial performance, but also to impact performance. So I won't spend too much time on how that works, but this is the principle is really at the heart. So that's why, the way you present, the way you provide us with this impact data, honestly, we don't care, but we care very much about where those data fit. And actually, at the risk again of sounding slightly trivial, if the impact is not met, that has to hurt somewhere. It's too easy to put impact forward in the fundraising phase and forget about it once you have the fund up and running. So in the due diligence phase, that's very much what we look after. And I think here our fund-of-fund approach is very close to a fund approach. You're looking for driven entrepreneurs who are really living this impact, who are putting together a business model that does address social and climate issues. Same for us when we look at the GPs that are asking for funding. We would very much look at the intentionality and even more so on the additionality of the impact strategy. Dropping a few figures, since we started actively investing in impact, that was back in 2012, we've invested close to 870 million euros across close to 60 impact funds, 60, across Europe, social impact funds. Once we're convinced about the theory of change and the impact strategy of the GP, then we go all in. On these 60 funds that we've backed, 60% of those we represent more than 60%, 50% of the fund size. So that means again, once we're convinced, we go all in, and we do not have a risk aversion. again, also, of all the investments we've closed in the social impact space, more than 60% of the investments we've closed are towards first-time teams or emerging teams. So because we follow that path, we obviously need to have a very clear-cut assessment of the impact at the moment of the due diligence, but also during the holding, across the 10 years of the fund lifetime, and obviously also when on liquidation, on the termination, we would look at whether impact stands to know or to decide collectively whether the GP is eligible for carried interest or not.
Wonderful. What do you want to?
Can I just say one quick thing? So on the, you said if the impact is not met, it has to hurt somewhere. I think this should go the other way as well, right? That if the impact is overachieved, there needs to be a benefit of it. And I think this is one of the areas where the system can still improve. And the methodology, because the model that I see most often is that if you achieve or overachieve your impact, the maximum you can get is 100% of your carry. Whereas for every bonus for a salesperson, every overachievement that we see sort of anywhere, usually if you overachieve, you also get a bit more, right? So I think this is also something that maybe needs to be looked at a little bit, that there are also aligned incentives, not just on the downside, but also to overachieve.
And I'd like to add here, thank you so much. I absolutely agree with all you've said, and what I've seen also in the last years, and I think this is also what you both said, is if a startup or a company says they are an impact business or a social business or an eco business, it is so important also to support them along the way, not only with classical financial instruments, but also with capacity building, because at last year over 200 founders in programs and coachings, and I see so many just ticking boxes for the SDGs, not even knowing that there is a definition behind, don't know the indicators, so I still see also in this bubble a lack of knowledge still. And on top, I also see that there are so many interesting companies and so many interesting startups who are doing fantastic things, but they would never ever call themselves like an impact business, and they don't know that there are specific funds, there are specific programs, and we need to open them this world as well. So this is also like the bubble bursting. So that's the reason I really love to work with larger funding houses, because they have a huge range of different projects and companies they invest in. And if you look into this, you find very interesting things. And I think we should, push there as well and be out there and speak to them, not only in our own bubble.
We share on a weekly basis newly launched impact funds, as well as programs, grants, prize opportunities. So
very
you can
cool.
Send them to our LinkedIn for that as well.
We will.
But I think we also have to see how do we make sure that the conversation goes bottom up, top down, and everything, right? Because I'm focusing a little bit more into the venture capital world, for example, right? You know what you're looking for. You are looking for LPs that are aligned to what you're looking for, but you also need to align with the startups, and the startups should know what. The problem is that the startups, it's not easy for them to be aligned also to what LPs are looking for when they invest into their own GPs. I don't know if you get me. It's like three different worlds out there. And maybe that's also a problem, because when it comes to regulation, you have all these instruments and all these reports to be done that don't match reality, right? But I wanted to ask you something, Cyril, based on what Josefine was mentioning before, right? What is the way the EIF measures or the process of due diligence of the EIF when it comes to diversity, equity, and inclusion, which are which I think is the part of ESG that's harder to measure, harder to be able to say, yes, this fund has these policies, etc.
So on the DEI topic, it's obviously one that also we carefully look at. Not all gender/DEI strategies fall under the impact practice, to be honest. We view, that's our view, that if, for instance, a tech VC is raising with a strategy that says at least 1/3, at least half of the founders or the C-level in the company have to be women, for instance, or diverse, whatever direction diversity is taken, then we would invest. For us, that's obviously, don't get me wrong, a very welcome and needed approach, but that would not qualify for us as an impact strategy simply because you take a snapshot, you filter, you look at a certain part of the companies that enter your deal flow and would deliberately only look at this part of the deal flow that is eligible to eventually proceed with an investment. We were very happy to commit into Fund F that you mentioned, that is based here in Vienna, and that has this gender approach. It is combined there with an impact approach. And here, when we do, well, basically we would ask, in line with the impact methodology I was referring to earlier, that yes, there certainly should be a filter around what is the gender composition of the founder, or of the management board, of the C-level functions, etc. But it needs to go beyond, meaning what is the recruitment policy, what is the internal promotion policy, are there perhaps some specific working arrangements to make sure that both men and women can progress and work and strive in the company. So this, in our view, would match both the gender approach, that is again so badly needed, but also an impact approach whereby no matter what the company produces, the gender approach, the diversity approach is always at the heart of the way the investment or the company evolves. But beyond that, and as I was saying earlier, it's not simply a tick the box that you need to have in your due diligence phase, but that's also throughout the holding, even past the investment. You need to also be accountable as a founder for, and as a GP, for your gender diversity strategy. So that's where, again, substance over form. What matters is really what kind of metrics you are looking at and how much these metrics would reflect actually your theory of change, be it around the gender, be it around certain social issues or around certain climate issues.
Wonderful. I think we just can, we take this part, no? Let's keep substance over form, and especially today, and maybe just to wrap up before we take, if there's any question from the audience, please raise your hands and we can give you the microphone. But meanwhile, maybe we can say, or who wants to say, what do we have to do to make sure this period of uncertainty, you know, where everything related to everything we have been building in the last years, it's kind of not under scrutiny, but it's not popular anymore, right? I remember I was on the podcast, I was talking to a person from a government agency, and he said he had to cut the word ESG from his title, you know, from his job title, because he wanted to have access and he didn't want to have any issues when talking to Americans. Stuff like that sound not relevant, but they are, right? So how can we make sure now from in the near future, to keep this level of involvement, of growth, of maturity, and keep maturing instead of going backwards? Who wants to take this one? Nisha.
One way to do that is to show the benefits of doing good work, you know, so which is not yet done. So data speaks. If companies have done ESG and their performance, I mean, when I say ESG, it's basically KPIs or green KPIs or social KPIs they've achieved, and what's the impact has been on their financials as well. That's one way to convince, because as we all know, for the Omnibus Directive, ESG is considered as a cost center, and then we have to shift that mindset towards, no, it's not cost center, but let's make it as an impact center or investment center, most focus. You know, whatever you invest, consider that as an investment in green initiatives or social initiatives, rather than considering them as cost initiatives. Here's one thing, I mean, that I feel would be beneficial.
I don't know. Maybe this is a bit idealist. I don't know what you want to classify this as, but I think now is not the time to drop our values. and it's not the time to be silent. It's not the time to adjust what we stand for, what we invest in, what we believe in, just because some dudes in the US say this is not the thing anymore. I just think there is a bit of putting our foot down on impact as well, and embracing a bit of an entrepreneurial spirit in pivoting and finding the right ways of talking about it, bringing other people in, challenging the way we've been doing things to see if there are better ways, maybe more inclusive ways even of doing them, but nevertheless actually sticking to our why.
I'd like to add on here, thank you so much. I think trends come and go, right? We see them coming and going, and as you were saying, they have a large effect, right, on what is happening, as the examples we were hearing. But still, there are so many people having an intrinsic motivation to work towards a better world, whatever that means. This is a very large topic. But when we talk about impact, I define it as like a positive intended change for an entire society or a minority or for an ecological sphere. So now is the time to look a little bit deeper and maybe scratch a little bit deeper, to look for these people, to look for these companies who are doing it, and also hold politicians and decision makers accountable for what is happening there. We know this can be tough, but this is what at least we try every day in our work, to hold them accountable and say, even so it is unpopular right now, this is what written, let's say you're getting fundings from the EU, this is written in the documents, and this is what you should do. And then give them a hand and support them and help, so that they can stay strong, that they know there are networks, they know there are consultants or whatsoever people who can support doing their job, because for many of these funding houses, for many of the people who are giving out the money, it's not easy, it's complex, it's messy, it's political, it's massively political, and these are the places of power, so we should not go back, but step up and speak up.
I love it.
Party.
Sir, do you have anything to say? Just tell us that you don't care. I mean, that you keep investing. That's your role. I mean, you are the biggest venture capital investor in Europe. So, just knowing that you do care about this is good enough for us.
For sure. I mean, that's again goes without saying that I mean, I think we've been among the first DFIs to launch a full-blown mandate exclusively dedicated to impact. That was, more than 15 years ago or 15 years ago. So we are here to stay, because that's very also close to our values. We have in the Articles of Association of EIF 2 articles in particular that say so. One that says we have to ensure appropriate return to our shareholders. Let you guess around the appropriate. Second says that we have to pursue EU policy objectives. So impact investing is very much embedded in our own structure, and we are here for the long term. Fact is that also when we started, and that's also me here quoting Kohli that you've heard yesterday evening, we always viewed our role in this business, in this strategy, our role is to make ourselves redundant. So there is also an anomaly somewhere if we, year after year, continue to represent 50% of the fund size in impact funds, because the core reason why we started this business in the first place, and business is perhaps not the best word, but excuse the shortcut here, but when we started investing actively in impact investing, the idea was precisely to prove that yes, you can invest in an investment remit and an investment setup that does both financial performance and impact performance. I'm not talking about the level of return and market above, higher, at par with market return, but the positive correlation does exist. The reason we are aiming for that is precisely to help persuade and convince the real source of capital out there that this is an investable strategy. I'm not sure I want to talk about asset class, but it's an investable strategy. And the schizophrenia we go through, or some players go through, making money with the right hand and trying to do good in some ways marginally with the left hand is not sustainable. So we have, I see collectively, and that's not a public investor prerogative, that's not an exclusive prerogative of the entrepreneur or fund managers, to demonstrate that actually the two are not mutually exclusive, and it's our collective responsibility to demonstrate that you can achieve both financial performance and impact performance. But then I think also perhaps I'd like to use the parallel with the GDP indicator. To me, this is very much an indicator type of dynamic. If we stick to TVPI, DPI, multiple indicators that are relatively immediate financial, short-sighted type of indicators, I'm not sure that would lead us into the right direction. Us keeping on looking year after year at the annual growth, which is a GDP growth, and ultimately using GDP as our North Star KPI is not helping us, because that's very much the one that dragged us into dangerous territory. So if there is one contribution impact investing should bring to the debate, is this one. Look at the variety of indicators, and perhaps, hopefully, and also being slightly idealistic here, hoping for the day when we have an IFRS, or reporting standard, an accounting standard that captures not only financial ones or financial performance, but also everything that it took to get to that kind of financial performance. Yeah.
Wonderful. Well, we have to wrap up. I just want to take two things that were just said just right now. Josefine, you mentioned we need to keep our politicians accountable. Now remind them that why we are in this level of why we're mature now, and then don't forget we need to keep working on this. But on the other side, as you were mentioning, Cyril, we need to also find a way to bring the private investors into this, to commit for real, and not only for the sake of financial benefit, which is also something that they can accomplish through this. But I think those two worlds we have to make sure that are very embedded into this challenge. So thank you very much. I don't know if there's any question. I don't see any hands. No? Well, thank you very much for your time, and thank you very much to the panelists.